Let's jump right into this explainer and unpack what is arguably the hottest topic in the crypto markets right now. Seriously, if you've been chasing yield or holding stablecoins lately, you absolutely have to understand Ethena's USD. It's a project that's literally challenging the very definition of digital money. Because the question on everyone's mind is this: can this rapidly growing, super high-yield digital asset actually succeed where past algorithmic projects just spectacularly failed? I mean, to say there's skepticism mixed with massive enthusiasm right now would be a total understatement. So today, we're putting feelings aside and relying strictly on the data to see exactly how this engine works. Section 1. The Stablecoin Challenger. To really understand the massive hype around USD, we first need to look at the explosive market context surrounding its launch. Take a look at the macro environment, because it's everything here. Notice the direct correlation between stablecoin liquidity and broader market health. The total stablecoin supply bottomed out around $123 billion back in 2023, right? But since then, it's surged by over $32 billion. And this influx of fresh capital has perfectly tracked Bitcoin's massive price rally that kicked off in late 2023. Bottom line, there is a huge, undeniable demand for stable liquidity right now. And right into that environment steps Ethena. Now, while traditional giants like USDT have definitely extended their dominance, actually recording a year-over-year increase of $33 billion, Ethena's USD is the new formidable challenger on the block. Since launching in mid-February, it literally soared past a $2 billion market cap by early April. For a brand new asset to capture that much market share that fast, it's staggering. It absolutely demands we look closer at how it actually operates. Section 2, decoding the synthetic dollar. And what's really fascinating here is we kind of have to change how we define stablecoins completely. In fact, Ethena Labs claims USDe isn't a stablecoin at all. Instead, the protocol calls it a synthetic dollar. Why? Well, because unlike traditional stablecoins, it's not backed one-to-one by fiat cash or US Treasury bills just sitting in some bank account. Instead, it relies on a time-honored traditional finance strategy, delta-neutral hedging. In really simple terms, the protocol holds spot crypto assets and simultaneously shorts an equivalent amount using perpetual futures contracts. This basically cancels out the price volatility of the underlying crypto, which results in a net exposure or delta near zero. Synthetically, it creates a $1 value. So the absolutely crucial point here is that USDe is fully backed by crypto collateral. When it initially launched, they only used Ethereum, but recently they onboarded Bitcoin as a backing asset, and this brilliantly illustrates their strategy for scale. Think about it. Bitcoin has a massive $24.4 billion in perpetual open interest, meaning the total number of outstanding derivative contracts, compared to Ethereum's $10.3 billion. By adding Bitcoin, Ethena unlocked a massive 2.5 times expansion in scaling capacity. As a result, Bitcoin now accounts for over a third of Ethena's backing collateral. Section 3, the internet bond yield. Let's be real for a second. The primary reason capital is flooding into USDe isn't just because of a clever peg mechanism. It's the yield. So let's open up the hood, follow the money, and answer the ultimate question: where exactly does this massive double-digit yield actually come from? Ethena calls USDe the internet bond, and its engine generates yield from two very specific sources. First up, you have staking rewards from the underlying Ethereum collateral, which typically pays around 3 to 4% just to secure the network. Second, you have the delta hedging strategy itself. Now, in crypto perpetual markets, long position holders historically pay short position holders a funding rate to keep prices aligned with the spot market. Because Ethena is taking massive short positions to hedge its collateral, they are the ones collecting those funding payments. Now, the math totally checks out, and the yields are entirely provable, but you need to pay close attention to the variability here. You're looking at averages of roughly 9 to 10% annualized over longer periods, sure, but earlier in the year, it temporarily spiked over 100%. The critical takeaway here is that these returns are deeply, deeply dependent on crypto markets remaining largely long biased. It's essentially a cash and carry trade. It works beautifully, as long as the market is feeling optimistic. Section 4, USDe versus Terra UST. Now, whenever we talk about a new digital asset generating massive double-digit yields, it inevitably brings up the ghost of Terra UST. We absolutely have to address the elephant in the room and put these two models head-to-head. But the truth is, the mechanics between the two are fundamentally different. Terra UST, the infamous protocol that death spiraled, was completely unbacked. It relied on an algorithm tied to its sister token, Luna, and promised this impossible fixed 20% yield that wasn't actually generated by real market activity. We all know how that ended. Athena's USD, on the other hand, is fully backed by Ethereum and Bitcoin collateral. It uses a grounded, proven delta hedging strategy. And most importantly, its yield varies dynamically based on actual market funding rates. It's not promising a fixed rate out of thin air. It pays what the market actually generates. So when you apply the famous stablecoin trilemma to this, balancing scalability, stability, and decentralization, Ethena aims right down the middle, but it definitely leans heavily toward massive scalability and peg stability. To achieve that kind of scale, they do make an initial trade-off in decentralization, because decentralized exchanges simply don't have enough liquidity for these massive short positions yet. Ethena utilizes centralized liquidity venues to execute its hedging. Section 5. Evaluating the risks. The theory is mathematically sound, but we always have to look at the sober reality of the risks involved. Because no financial protocol is invincible, right? Let's walk through these risks. The absolute biggest one? Negative funding rates. If the market turns deeply bearish, shorts have to pay longs. That means Athena's protocol would have to pay out to keep its hedging positions open, which directly threatens the yield and, eventually, the peg itself. Secondly, there's counterparty risk. While they do use secure off-exchange custodians like Copper and Cefu, they still rely on centralized exchanges for derivative settlements. You've also got liquidity risk, if a massive rush to the exits causes their staked Ethereum collateral to temporarily depeg. And finally, just your standard operational risks associated with Ethena Labs itself. So, how does Ethena defend against that terrifying scenario of negative funding rates? Well, by pointing to historical data. Funding rates actually have a strong positive skew. Over the past 3 years, which, remember, included a pretty brutal bear market, only 16 to 19% of days saw negative funding rates. To buffer against those specific days, Ethena maintains a dedicated reserve fund. That fund is currently sitting at around $37 million, capitalized by a portion of the protocol's profits. It's specifically designed to step in and cover potential funding deficits. It really is an incredibly fascinating structural design, and it's practically forced the entire market to pay attention. So the final thought I want to leave you with today is this. The mechanics of the synthetic dollar are clearly grounded in established financial theory, and its early scale is just undeniable. But as crypto markets mature and these lucrative basis spreads inevitably tighten, will USDe remain a permanent evolution of digital money? Or will its mechanics falter under the ultimate test of a brutal, prolonged bear market? The math is sound for now, but in crypto, time and the data will be the ultimate judge.